Welcome to This Explainer. Today, we're diving into the exact legal strategies wealthy individuals use to drastically reduce their tax bills. Now look, before we jump in, I want to be super clear. Our goal here isn't to hunt for secret, shadowy offshore bank accounts or illegal schemes. The reality is actually way more fascinating than that. Most of the wealthy don't hide their money at all. They just use legitimate strategies written directly into the law. So today we're going to break down these exact strategies, and honestly, it's probably going to completely shift how you view the entire financial system. Let's get into it. Okay, let's start with a really simple scenario. I want you to imagine two people earning the exact same amount of money in a single year, $100,000. The first person earns it all through a traditional 9-to-5 salary, while the second person makes their $100,000 entirely from investments and businesses. They generated the exact same amount of money, right down to the penny, yet the person making their money through a salary pays significantly more tax than the one earning through investments. Seeing a massive disparity like that, well, it forces us to ask a pretty crucial question right out of the gate. Is the system just completely broken? Are wealthy people just somehow cheating the system? Or are the wealthy simply following an entirely different instruction manual? The surprising truth is that they are playing by a completely different set of rules. And the crazy thing is, these rules are actually available to anyone, but very few people truly understand them. So we need to bust a massive myth right now. Most of us naturally think taxes are just a giant collection bucket, right? You earn money, the government takes their cut, end of story. Actually, scratch that. That's only true if your income comes strictly from a paycheck. In reality, the tax code is designed by governments to be a massive, complex behavioral incentive program. The system isn't just there to take your money, it's deliberately engineered to encourage specific economic behaviors, like investing, starting businesses, and building housing. To really wrap our heads around this difference, let's compare two totally different professionals. On one side, we've got Sarah. Sarah is a highly skilled engineer earning a fantastic $150,000 salary. But with every single paycheck, her taxes are deducted automatically. She has virtually zero flexibility. On the other side, we have David. David owns part of a rapidly growing software company. Instead of taking a huge salary, his wealth grows as his company's stock rises in value. And here's the real kicker. As long as he doesn't sell that stock, his wealth increases significantly without triggering any immediate taxes whatsoever. And this right here brilliantly illustrates the core difference in wealth building. Employees earn taxable income. Owners build assets. Because the government actively wants to encourage business growth and investing, the tax code treats these two things very, very differently. That simple distinction between earning an income and building an asset is literally one of the main reasons ownership has historically been such a powerful wealth-building tool. So, you might be wondering, what happens when David's assets actually grow and he finally wants some cash in his pocket? Well, that brings us to capital gains. When an investment increases in value and is sold, that profit is called a capital gain. In a lot of countries, governments intentionally tax long-term capital gains at a much lower rate than an ordinary salary. Why on earth would they do this? Simply because governments want to reward people for patiently investing capital back into the economy. It's not a loophole. It is a feature written directly into the law to encourage long-term business investment rather than constant short-term buying and selling. Furthermore, for those who actually own businesses, there's another major factor at play: deductions. Now, business owners don't just get handed free money, but they are legally allowed to subtract legitimate business expenses from their revenue. Things like paying employees, buying equipment, upgrading software, or running a marketing campaign, these are all costs that can legally reduce their taxable profit. The business is only taxed on the remaining profit, not the total revenue that originally came in the door. This is a massive, deliberate incentive designed specifically to encourage business owners to constantly reinvest in their companies and ultimately grow the economy. Let's look at how this applies to real estate with a fascinating, honestly almost paradoxical rule called depreciation. Depreciation is an accounting concept that lets real estate investors write off the declining physical value of a building over time, which makes sense, right? Roofs age, paint peels, things break down. But the incredible part is that they can take these tax deductions even as the property itself becomes more valuable on the open market. It's this powerful, totally counterintuitive combination of income, long-term appreciation, and intentional tax incentives that makes property investment incredibly popular among the wealthy. Now, you might be thinking this is only for billionaires, but these incentives aren't just reserved for real estate moguls. Everyday workers can utilize these exact same principles through retirement accounts. Millions of people can contribute to these accounts to legally grow their investments tax-deferred, or in some cases, entirely tax-free. And why does the government willingly hand out this tax break? Because it significantly reduces future pressure on public support systems. Basically, if you fund your own retirement, the government doesn't have to. It's one of the easiest, most accessible legal tax strategies out there. Yet, surprisingly, a lot of people never take full advantage of it. Okay, let's scale things way, way up and look at a fascinating, high-stakes problem that the ultra-wealthy face. Imagine you're holding $50 million in highly appreciated company stock. You want some cash to buy a luxury estate or maybe fund a massive new project, but you know that selling those shares will instantly trigger a massive capital gains tax bill. So how on earth do you get the cash to spend without paying the tax? Well, instead of selling, they use a strategy that honestly sounds like the title of an action movie. Buy, borrow, die. They legally borrow cash from a bank using their $50 million in shares as collateral. Because loans inherently have to be repaid, tax agencies do not classify them as taxable income. This allows wealthy investors to access massive amounts of cash without immediately selling their appreciated assets. Now, it's certainly not a magic trick, and it carries very real financial risks, for sure, but it is a complex, fully legal planning strategy they use to expertly navigate the rules. We see this behavioral shaping happen yet again with large charitable donations. Many wealthy individuals donate large amounts of money to charity. Now, while many genuinely want to support causes they believe in, this philanthropy also serves a second purpose, legally reducing their taxable income. Governments actively encourage this by offering generous tax deductions. The public benefits from the funding, the charities get the essential resources they desperately need, and the donor significantly reduces their tax bill. It's a crystal clear example of how tax policy is used to legally shape social behavior. When we impartially map out these rules side by side, the tax code reveals itself to be way less of a penalty and much more of a bounty system. Think about it. Governments want certain things for society to function well. They want jobs, housing, innovation, and retirement savings. So, to get those things, they offer a straight trade. Legal tax incentives like business deductions, real estate depreciation, lower capital gains rates, and tax-advantaged retirement accounts to absolutely anyone who provides them. It is a direct, literal exchange of value for tax reduction. So, the absolutely crucial point here is this. The wealthy don't necessarily win simply because they're smarter. They win because they deeply understand this rulebook. Most people focus entirely on working harder for a paycheck, which, as we've seen, is the most heavily taxed form of income. But the wealthy also focus heavily on financially educating themselves on asset ownership. The ultimate takeaway from this explainer isn't just some ongoing debate about fairness. It's recognizing the profound, paradigm-shifting difference between earning heavily taxed income and legally managing assets that the government actively wants to protect and reward. Which brings us to our final thought for today. The real difference isn't secret offshore accounts, it's understanding the rules of the game. Now that you know the tax code is actually a massive incentive program designed to reward investment and ownership, how will you use this knowledge? Knowing these rules, how will you apply these exact same incentives to rethink and reshape your own financial journey? Thank you so much for joining me for this explainer. Keep learning, keep asking questions, and I'll see you next time.